In this video, we're going to talk about Fuelcell, trading under the ticker symbol FCEL. Fuelcell is a company operating in the energy generation and management sector and has developed several alternative energy generation methods over the years. Its appeal is, on first hand, the fact that generators use natural gas to power up the generators, which is more environmentally friendly compared to the combustion generators. Many retail investors initially discovered Fuelcell because they were looking for fuel cell startups that are looking to develop hydrogen-based solutions. Of course, Fuelcell the company is mainly using natural gas, but nevertheless it fits the profile of many retail investors who decided to put their money in the company's stock. Essentially, Fuelcell is surfing on the popularity of hydrogen, a bit like EV companies are surfing on the high stock price of Tesla. Fuelcell has been operating for decades and is a well-established company with stable and predictable cash flows. In a way, it is an established company with renewed demand and curiosity from the rest of the market. The trading volume of Fuelcell has recently been 22.7 million shares compared to an average volume of 25 million shares. Over the previous 52-week period, its price has fluctuated between $4.83 and $29.44. The market cap of Fuelcell is currently at $1.9 billion, compared to an enterprise value of $2.75 billion in its enterprise value. The difference between the market cap and its enterprise value is the premium or discount financial market is willing to allocate to the company based on its current fundamentals, leverage, asset compositions, and macroeconomic trends. Some of the examples of impact by leverage is if the company has a lot of debt, then the market may feel uncertain about the company's capacity to pay back its interest and principals, which in turn may negatively impact its profitability and solvency. Another key element to understand why there may be a discount is the asset composition of many companies, and it's especially true for growth-type companies. For many of those, one of the most significant assets they own is goodwill. Goodwill is basically an expectation of the market that the company is able to generate more profit and to have more growth than other companies, partially because it has a good management, stronger brand recognition, bigger following online, and so on. In other words, it's not a tangible asset that companies may use. However, it's often the reason why some companies are perceived to be trading at a discount, because the market cap is lower than the enterprise value, which is the value of market giving to the assets once the debts are paid off. With that being said, in the case of Fuelcell, my feeling is that the company is subject to a lot of speculative element. So this is why whenever things are not looking that good, a lot of people would immediately sell. A lot of people would immediately sell their holdings. This is also a symptom of something that may happen when a company has most of its shares among the retail shareholders. In comparison to its historical price fluctuations, the stock is 10% higher than the 1-month low, 10% higher than the 3-month low, and 10% higher than the 1-year low. In terms of the options market, which often gives a hint on the market sentiment on where the stock price is likely going to head toward, the implied volatility is 93.5% compared to a historical volatility of 89.7%. A put-call volume ratio is currently at 0.49. The most recent volume of options traded has been 40,000 contracts a day compared to the 30-day average of 45,000 contracts. In terms of open interest, the most recent volume of open interest has been 418,000 contracts compared to a 30-day average of 388,000 contracts. In terms of its shareholder structure, institutional shareholders hold 41% of its outstanding shares. The biggest shareholders include BlackRock, Vanguard, and State Street. The relevance of shareholder structure is important here to determine whether you should be holding the stock long-term or view it as a short-term volatility play. If the stock is mainly held by retail traders, then it may be a sign that the stock lacks the depth to justify long-term trust from shareholders. Of course, There are a lot of exceptions from what I just said above, but usually the consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment, not just a short-term trade. Let's also look at the short interest present in the stock, which is the amount of positions that aim to profit if the share price falls lower. Sometimes, if there are significant short interest in the total volume, it could be a sign that there is an organized shorting operation going on, like what has been going on with GameStop and AMC. The current short interest is 12.9% of the total float and 43.4% of dark pool transactions. Let's also take a look at the indicators. Financial indicators give us a suggestion of what the price movements are suggesting, but they can also be used as one of the elements to consider what should be the overall approach. The oscillators are showing 1 sell, 9 neutral, and 1 buy. And overall, the tendency shown by the oscillators is neutral. The moving averages of the past price action have 14 sell, 1 neutral, and 0 buy. The overall tendency from the perspective of the moving averages is strong sell. The moving average can be used to determine whether the stock is overbought or oversold compared to its previous price fluctuations, which can be used to see if your trade is sufficiently well timed. In terms of pivot points, which are levels of support and resistance sprinkled in the price trends, the support levels are $4.05, $4.44, and $4.82. For the resistance levels, they are $7.86, $8.92, and $10.51. Looking at Fuelcell from both a corporate and equity perspective, Fuelcell is a decent company with an established history, but like the rest of the market, it's subject of being influenced by the current speculation element. Actually, compared to other growth stage companies, I would say that Fuelcell may be more vulnerable to macroeconomic changes as well, which are happening right now. Fuelcell is massively owned by institutional and retail traders expecting to do well, but also to be able to last. But maybe in addition to those typical reasons, I think that there's also an equation in retail traders' mind of Fuelcell equaling hydrogen. Market participants, and more specifically retail traders, are attracted by the company because its name carries the word Fuelcell, which corresponds to a narrative that leads to people believing that the company is going to revolutionize the sector. This is not the case since Fuelcell is mostly operating in natural gas and not really in hydrogen. My opinion on the company remains that it's worthy of your time and that it deserves to remain on your watch list and maybe in your portfolio if you're risk tolerant. Because in a way, we're hoping for the stock to have a lot of demand from retail traders who assume that Fuelcell always means hydrogen. To be honest, even if it sounds bizarre, it has worked in the past, and nothing suggests that it won't happen once again. In terms of its price action, the overall trend seems to be ranging between different peaks and the same support line over time, which has proven to be a solid support for the time being, and a rebound is expected to happen sometime soon, even if for the moment we're not certain where the stock is going to land for its peaks. My recommendation is to make sure that your exposure in Fuelcell is at a maximum of 0.5 to 1% of your portfolio, and to buy in small batches as we go forward, with 25% of the allocation in the current price level. Regarding the profit target, I would say that the previous peaks are a good place to look. Your investment should also take into consideration the market conditions and the surrounding sentiment to determine what kind of asset should be picked, for how much and for how long. First of all, the financial market doesn't reflect the real economy. If the stock market is doing great, it doesn't necessarily mean that companies are hiring people, that salaries and living standards are rising. Sometimes it's the exact opposite that happens, because the stock market is a pool of money where things come in and come out, going to different sectors to be placed. The capital may be used to be invested in a company to improve its efficiency and productivity, but it can also be used to buy up shares and assets in order to make a profit. This phenomenon is called financialization, and it means that the more money is being used for non-productive purposes like merger and acquisitions, fees to financial sectors, buying back equity, and so on, the less there is for the real economy. Another way to put it is that ever since 2008, the Dow Jones has increased significantly. But people don't necessarily see this growth in tangible ways. This is why we gotta be careful with the assumptions that rising stock price means better outlook for the company. Sometimes it doesn't mean anything other than the fact that the asset is getting more expensive to be bought and that their yields is going down as a result. Additionally, some new phenomenons are now palpable, such as the creation of new bubbles, the participation and influence of retail traders in specific situations, and the anticipation of a massive recession or at least pullback. Bubbles have always been created on and off over the past few centuries, but nowadays it's quite interesting to see the speed at which an organic bubble can be created back in 2020. Because almost immediately after the major collapse of the financial market back in early 2020, the market decided to pour a massive amount of capital in the EV sector and anything that's related to it. Stock prices went up the sky, and for a moment, it really felt like any EV stock can be a golden goose. Another way to say this is that any SPAC with an EV company in it will become the next Tesla, right? Even if it didn't last that long, this episode definitely allowed the market participants to park a lot of their money in a sector, leaving it with either a lot of profits or at least avoiding incurring large losses because they left their money in the blue chips or the sectors heavily affected. The involvement of retail traders in companies has also been much more pronounced in recent months, especially in the scenarios of a short squeeze. Companies may have short sellers who believe that the stock will decrease in value. The short squeeze consists of buying the stock price up to force the short sellers to recover their positions, which will then also trigger an even bigger increase of stock price as a result. Of course, I'm not saying that this is always rational. I'm not even saying that those companies always have a convincing narrative. So, for example, if you play video games, ask yourself if you personally bought all your games at GameStop, knowing that you can buy the same games just online in the comfort of your home. But nevertheless, retail traders do have a much more significant influence in the stock price nowadays, for the better or worse. Personally, I think that as long as the volatility is high or gets higher, it'll create more opportunities. The final phenomenon is the anticipation of a recession. Many people have been expecting something of that sort to happen ever since 2008. There were quite a few companies that were supposed to go bankrupt because their debt structure is no longer sustainable or that their business model is bad. But overall, the system was able to hold its ground, especially in the North American market. This is partially because capital around the world often choose to come to the American capital market when things get heated back home. This is especially the case when geopolitical tensions increase around the world. In order to make sure that capital can provide a steady return without being affected too much by the central bank policies and inflations, I think that this phenomenon will increase its pace as time passes by, at least for the next couple of years. This is why we will likely see the blue chips continuing their ascension, even if for the growth stocks, things may be a lot more nuanced. The bottom line in all this is that the environment is getting more uncertain and volatile in a context where asset yields will probably remain quite low, because the real economy cannot be improved with just money. As far as we're concerned, this means that the patience would be a great virtue for all of us, and that there will be plenty of opportunities to eye for better prices. With that being said, always make sure to keep your positions diversified and keep the risk level under check. Speculative positions should play a small part in your overall portfolio. I would say it's better to keep them below 10 to 20% of your total holdings. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.